I wrote a memo, one of those ones you referred to, and the title was Calibrating. And I think that it's all a matter of calibration. And when I go on TV, they try to get me to say buy or sell, in or out. And it's not that black and white. Um, when should you own more and when should you own less? That's the question. By the way, it's kind of a distraction to think about buy, sell, buy, sell. Own. We own investments. When should we own more and when should we own less? And I think that's a rather easy question to answer. We should own more when the environment is hospitable, and I'll define that in a minute, and prices are low. And we should own less when the environment is precarious and prices are high. Again, this is all discussed in the book about the cycle. But what does it mean for the market to be precarious? Well, I described it a bit ago. I said it occurs when investors are optimistic and there's not much risk aversion and there's a lot of money and a lot of eagerness to put it to work. So when these things are true, then everything else being equal, it's likely that asset prices will be high relative to asset values. That's really the key determinant. Where does the price of what you're considering holding stand relative to its intrinsic value? And that is determined by factors like the ones I mentioned. Let's simplify it. The more optimistic people are, the higher the price is likely to be relative to its intrinsic value, period. And you want to buy when the price is low relative to the intrinsic value, or perhaps doesn't reflect all the merits of the intrinsic value. And you don't want to hold that much. Maybe you even want to sell when the price is very high relative to the intrinsic value. So, my point is that in the middle of March, we saw a real panic, and Oaktree invested aggressively in the things we buy, which are mostly credit instruments, especially from March 9th, when the panic, I would say, set in, until March 23rd, when it abated thanks to the actions of the government. Things went on sale. Think of it as just going to your local department store. And when things go on sale, you should buy more. And we did. And so, that's what we have done in past crises, and that's what we try to do. That's our job, is to own more when they're on sale. And then the government came out, and the news started to filter out around March 23rd about what the government and Fed of the US would do. And interestingly, here we are in this terrible environment, this terrible health pandemic. And from March 24 to 26, those 3 days were the highest returning 3 days in the last 80 plus years in the stock market, going back to the 1930s and the Depression. So you may say that it was a response to the government programs. You may say that it was a relief rally. And the market rose. The Dow was up 19.8%, I think, and the S&P 17.6. And so, well, guess what? After a rise of that proportion, and then it has continued higher, and the S&P, which was up 17.6 in those 3 days, is now up about 26% or so from the low of March 23rd. And that's probably the quickest trip into bull market territory in history. Bull market defined as a period when the market's been up 20% without a decline. So very simple. Things aren't as cheap anymore. They're not on sale to the same extent. You shouldn't own as many. Now, when I say you should own more, you should own less, most people don't want to jump around from day to day. Most people shouldn't be trading daily in, out, more or less. But the point is, we had a major move down. Things were put on sale. Oaktree bought. we had not a corresponding move up, but a strong move up, and we stopped buying as much because we couldn't get bargains of the same magnitude. And so we first we thought the risk was great in past years, and we were defensive. Then people panicked over the exposure of the risk, and we bought. And then people got more comfortable, and our buying slowed. That's the way I think about calibrating.
Thank you. That's very useful, and it's an interesting challenge because bear markets usually test the lows. There's normally a rally, and you said this in calibrating. Actually, you put the numbers there that showed that over the last, I think, 80 years or so, that when we've seen a decline as we've seen, there tends to be a rally, but then the market might test it once, maybe twice, maybe three times. And
I think the figure, Max, was 9 times out of 10.
Right.
And if you look at the last two crises, the bursting of the TMT, tech media telecom bubble in 2000, and the global financial crisis in 2008, each of the stock market declines, you saw a big drop, a rally, another big drop, a rally, and another big drop before we reached the bottom. Mm-hmm. So, it based on history. Now, there are no rules that say history has to apply, but based on history, the fact that we had a 34% decline of the S&P from February 2019 to March 23rd, and then a 26% gain since then, based on history, we would expect that there would be another testing of the lows, and maybe two. The other thing I mentioned in that memo was that in the bursting of the TMT bubble, it took 7 years to get back to the stock market high of 2000. And it took, in the global financial crisis aftermath, it took 5.5 years to get back to the high of the stock market in 2007. If the stock market in the States rose another 15%, we would be back to the 2019 high. Do we really think that it's appropriate for the stock market in the US to be back at its highs after 2 months or 3 months? And despite this virus pandemic, and it to me it seems illogical.